Interesting to watch the headlines come out because, as expected, 25 basis points, it's a nice solid move for an economy that still has inflation way too high at 7.3% year over year. And as the headlines are saying, the economy is growing solidly. You know, unemployment rate's down near a record low. So they've got plenty of room to tighten up policy. They see GDP growth at 1.5% in 2023 to 2024, and their inflation forecast is going to peak around 8% later this year. So that's interesting, isn't it? That they still see the rate going higher before they see it coming lower. And of course, they, like many others, have been watching supply chains, food and energy prices, a very important thing there. Jobless rate is going to rise to a little above 4% in 2024. That's not too bad. And importantly, the size and timing of future rate hikes is going to be determined by the data, by CPI and jobs. Just classic central bank reasoning right now. This is the way they do it, as you know, Haslinda. They are going to watch what happens. Right now, they're happy with the 25 basis point rate hikes, unlike Westpac Bank, where Bill Evans thought they needed to step it up again to 50 and prove their inflation-fighting credibility. Phil Lowe and his team at the RBA apparently feel that they can keep it on this steadier rate. And of course, the latest headline, full effect of rate rises yet to be felt in mortgages. They're already having their home prices fall like crazy. And many people thought that would be a reason they'd stay at this slower pace because the housing market is suffering. It got way overheated. Now it's cooling off. And I think that that's another important thing to put in the pot. But again, we have to hear more from the RBA in a couple of days to find out just how big of a factor that has become.
Kathleen, it says that it is still data dependent. You know, we keep hearing that from the Fed as well, but it also says that inflation still remains too high. Is there a sense that perhaps the RBA could be caught? I mean, it could be too slow in raising rates or maybe pulling back too soon.
Well, that's a very good question, Haslinda. I think that's a question people are going to ask, you know, because a lot of central banks are afraid that they are going to move too fast and keep moving fast. And you know, these things don't happen all at once. You raise rates and even maybe your housing market starts cooling off rapidly, but your inflation rate can stay up there for a long time and come down slowly. So that's that delicate decision, you know, balancing act that you have to make. I think at this point, with inflation at 7.3% year over year, it's going up to 8% according to them. The economy is still solid. I think your question is one that people like Bill Evans from Westpac will be asking. Are you concerned that if you slow down now, you're slowing down too soon? And what's going to happen is when you find out 3 months, 6 months, that maybe you have to speed up again, where you would have been better to stay on the little bit more aggressive rate hike path and continue until you see that inflation coming down. For now, we know what they're doing, and the question is, of course, what they'll do next, and they'll say, well, the answer's in the data.
And of course, the RBA came out to say that there are three metrics that it's looking at: the global economy, household spending, wage and price setting behavior. Kathleen, you got to wonder how this is going to play out.
Well, I'm kind of an optimist here. I think partly what it is, look, their wages have been strong. Their inflation expectations don't seem like they're getting out of control. I think they're betting on some relief on the commodity price side, food, energy, supply chains, you know, kind of cleaning them out. But I think that one of the challenges for them to figure out, of course, look at China. Look at China. The COVID lockdowns have not stopped. Of course, they're going to stop sometime, but they haven't stopped yet. What's that going to mean for supply chains? How is that going to take the pressure off of inflation? In terms of commodity prices, that's when it's kind of easy to put aside. But the thing they have to watch out for, which other central banks are saying, like the Fed, is that you let it stay high too long and things start getting more entrenched. Services prices, if you work in a hotel, if you're an accountant, and if you see the pressures there and the prices are going up, you're going to keep pushing for higher wages as well. That's the kind of thing they have to gauge, and I would assume the next, you know, the 6 months are going to be critical for them.